I was just going to say we could go on forever. So let's go ahead and get started. I want to thank everybody for joining us. Today is Thursday, May 19th, 2022. It's great to see a lot of familiar names scrolling in. Everybody's logging in. It looks like we're going to have a good crowd today. So again, thank you for joining. A couple of housekeeping items. So as you probably know by now, everyone has been muted. On your Zoom window, though, at the bottom, you can ask questions throughout the presentation. There's a Q&A feature at the bottom. So please, by all means, send us questions as we go. Happy to make this as interactive as possible. We've got about 30 minutes of prepared remarks, and then we'll try to make sure that we connect with all the questions up until the top of the hour if need be. So the webcast is being recorded. We're going to post this to our website in the coming days. And we'll also make the slides that we cover today available to anybody that wants them. So please let us know. And if you know anybody that might benefit from this presentation, by all means, pass it on. Before we get started, I wanted to welcome Karina Olson to the Copperwynd team. Karina has joined us as our newest financial advisor, and I'm sure most of you will get to meet her soon enough. We continue to grow our service offering to you and hope that you quickly see the benefits of our expanding team. So welcome, Karina. I know she's watching. This webcast grew out of the pandemic, given that we couldn't see any of you in person. We needed to find a way to continue to connect with you, as well as our growing geographically diverse clients. So we've received a lot of feedback over the last couple of years. And while we have started to move through the last crisis, we find ourselves entering a new era. As you've probably noticed, Linda's not joining us today. Over the last few webcasts, we've changed the cast of characters, and we continue to mess with the recipe. With that said, David, Jake, and I will be in the kitchen today. So here's our agenda for today. I'm going to take you through the changes that we're currently experiencing. David's going to talk about the economic environment, and then finally, Jake will discuss our models and how everything that's been going on has impacted them. With our first slide shows us really how we got to where we are. The Federal Reserve has propped up risk assets, mostly stocks and real estate, by keeping interest rates at almost zero, really since 2008. So for almost 14 years now, it's amazing that we've gone this long, that the Fed has had our back. They have expanded their balance sheet along the way, in addition to keeping interest rates low. And this was the mantra that we talked about for years, is don't fight the Fed. We never knew how long it was going to last. How long can the market go up? But when the Fed is pushing money into the financial markets, it caused asset inflation. And that was the real estate and the stocks. So now the Fed is walking away, and they're really concerned. They're concerned themselves with inflation, which is one of their two mandates. And given this pivot, they're starting to raise short-term interest rates and reduce the size of their balance sheet. So now, interestingly enough, fundamentals of companies actually start to matter. Imagine that. And the Fed, we expect, will not have our back anymore after this very long period of time. So this next slide, as you see, is a chart for short-term interest rates going back 20 years. What we call the Fed funds rate. The average Fed fund rate over the last 12 years has been 0.47%, artificially and painfully low. The projected rate by the market now, as you see on the right-hand side, the dotted line, is 2 3/4, maybe even 3% by the end of this year. A marked difference, again, over the last dozen years. When we get through a crisis, say 2008, the Fed tried to return to normal interest rates. So you can see that in the chart back in 2015. They started raising rates, but they were only able to do that until the next crisis came along. And the reason they were able to really adjust rates up and down almost at will is because there was no consumer price inflation during this time. They were pumping money into the financial markets, hoping it would trickle down, but really that just caused asset inflation. So now on the next slide, again, this goes back to 2002, which shows the 10-year Treasury and how it's reacted to the various situations that we've been in. So now while the Fed controls short-term interest rates, that was the last slide, the market controls longer-term rates. The 10-year Treasury is what mortgages are based off of. And as you've probably seen, mortgages have headed higher. David's going to touch a little bit more on this later in the presentation. But academically speaking, it's generally positive when interest rates are rising because it means the economy is expanding. So Fed policy matters to the market. Now, this next slide has two pieces. It's the left-hand side shows the Fed balance sheet, as well as the right-hand side shows the S&P 500 index and what those two have done over the same time period. When we had QE, which is quantitative easing, bracketed here, it has been a tailwind for the markets. That is when the Fed was pushing money into the financial markets. Now, when we've had QT or quantitative tightening, it's been a headwind. As you can see on the left, the projected quantitative tightening that's coming in that red box on the right-hand side, the Fed's going to start to reduce their balance sheet. On June 1st, they said they're going to start reducing their balance sheet by $45 billion a month, doubling that to $90 billion in September. And that's the dotted line headed down to the right. But even if they keep on this projection of reducing their balance sheet, you can see it really doesn't even get them back to the pre-pandemic levels of what their balance sheet looked like. It's truly an unprecedented time. And really, that's the question on the right-hand side of the chart is what's the S&P 500 going to do? Is it going to be correlated like it has been in the past? And what are the markets going to do going forward? So given this really fundamental regime change, David's going to take you through how the economy is reacting and what we expect to see going forward.
Great. Thanks, Eric. So I'm going to talk a little bit about the economic environment we find ourselves in here. And as Eric talked about, fundamentals do matter. And we'll talk about the economics, in a big picture and then a little bit closer down into the U.S. economy. But when we look at GDP growth, both globally and in the U.S., it's going to be positive this year. Even though at the first quarter, it was a minus 1.4 here in the U.S., you look at corporate earnings and you look at consumer sales, it was still a good quarter. And you say, well, how can that be if it was minus 1.4%? Well, because GDP is how much we make as far as building and products, subtract the imports and add the exports. Well, all of those ships off Long Beach that you saw in the fourth quarter of Christmas that didn't arrive in time, when they were unloaded in the first quarter, that subtracted from GDP. And so it showed a negative print, but we don't expect that to continue into the second quarter. It should be probably 2.25% for the second quarter and somewhere between 2 and 3% for the full year. Now, you're going to have some issues, the China lockdown. China is having a zero COVID policy, which if you're North Korea, you can probably do it. China's not going to be able to do that long term. They're the second largest economy and they're a global trading partner. But you've seen Shanghai shut down and locked down for 45 days. It's opening up. I think you're going to see more of that, but it is going to cause some additional supply chain issues, which will negatively impact inflation. You're going to see inflation go up on some of those supply chain issues. And we're going to talk about inflation of what's persistent and what is transitory. Because if you remember a year ago, the Fed was saying, oh, this inflation going up is transitory. By the end of the year, it'll be back to 2%. That was a strategic mistake because some of it's not transitory, and we'll talk about that. And the monetary policy, as Eric has talked about, is going to be a headwind to the market and to risk assets, both on the stock side and the real estate side. And then you got the geopolitics. I mean, you've got the war in Ukraine, which is the biggest geopolitical issue in Russia, in Europe since World War II. Now, I'm not comparing it to World War II, but it is something that's a lot worse than we've seen over there, really in 80 years nearly. Now, when you talk about recession, could there be a technical recession technical recession is 2 quarters in a row negative GDP growth. We might have that, but I don't think it's going to be like we saw in 2008 or 9, simply because the bigger macro picture is much better than that. So let's start by looking at the labor markets. excuse me. On the labor markets, this chart sort of tells you all. Before the pandemic, we had a great labor market. We shut down. Unemployment went through the roof, but now it's back down to where it was before. And it's really the best labor market I've seen in my entire life. Anybody that wants a job has a job. I mean, that's just what you're seeing out there. And what you're seeing from nearly every company is when you say, what are the challenges you're facing? The number one challenge for nearly all of them is getting enough people that to fill the positions they have. So good labor market. So that means good consumers from that standpoint. If you look at the reopening data here, and everybody knows I love graphs, and this is really a busy graph, but if you look at the table at the top, all it's doing is saying, here are some metrics that you can look at of pre-pandemic, worst of the pandemic, and then post-pandemic, how does it look? And if you look at consumer and debit transactions, that's not dollars, that's number of transactions. At one point, it had dropped 34% when we locked down. It's now up 31%. And you're seeing that of people doing more things online. I was in LAX last week, and the airport in Los Angeles. Nearly all of the stores there don't take dollars anymore or change. You've got to pay with a debit or a credit card. So you look at hotel occupancy, with it down 70% nearly, it's only 4% below post-pandemic. And that's really because the business traveler hasn't rebounded as much. US seated dining, going into a restaurant and sitting down, one time it completely shut down, it's back to pre-pandemic levels. And if you look at TSA, people going through security, it was down 96% at one point. It's only down 9% right now. So as you look at that, we are reopening. You're seeing lots of people travel, and airlines filling up. So that is a positive for GDP. Now, if we look at inflation, this is going back really 50 years. And what you see on the left-hand side is in the 70s and early 80s, we had double-digit inflation. And we would have been happy for 5% inflation then. And Paul Volcker, who was the chairman of the Fed at the time, stepped in, did what nobody else was willing to do, pushed interest rate. Prime rate went to 21%. And most of you guys can remember back, you had 15% mortgages. People are belly aching about 5% mortgages. 15% was not fun, but it stamped out inflation for virtually 40 years. Now it's jumping up and it's above 5%. And the Fed is saying, oh, we got to do something, because as Eric talked about, their two mandates are full employment, and we're there, and inflation, which they say is 2%. And they've got to get it back down to 2%. So let's look at several of the areas of inflation. And one in the center part, that's, you're seeing fuel oil at 58% and gasoline up 43%. Other areas that you're seeing is the food side. You're seeing used cars and trucks up 22%. That is a transitory thing. You can't have them go up another 22%, because there'll be more, you'd be paying more for used cars than new cars. So some of that is transitory. But let's get into the granular part of some of the something that you see every week and every day, really, because you're eating every day. Let's look at the food prices on inflation.
Dave, one thing maybe to mention here is we've talked about it, right? Shelter.
Yeah.
Isn't that it's over a third of the index, right?
Yes, it's shelter, which is your housing costs as far as either rent or your payments. That and utilities, I think, is like 45% of the CPI numbers. That's a big piece. And we're really showing, when you look at shelter costs at 5.1%, it's a lot more than that. But if you had a 2-year lease, it hasn't gone up in 2 years. But when it comes up again, it's going to be up a lot more than 5%. That's one that is going to probably linger for several years of pushing those rates up, even though they don't reflect it right now. So if we look at food prices, all the way from eggs up 22% to butter up 19.2%. Let me just focus on eggs. I like eggs. Everybody likes eggs. Why are they up 22.2%? Well, part of it has to do with supply disruptions and stuff, but on them specifically, there has been avian flu in some of the flocks in the Midwest. Well, when you get avian flu in your flock, you have to kill all your birds, all of them. And then you have to disinfect all of your property, and then you have to wait, and then you have to get little chicks, and you have to raise them until they are laying chickens. So it takes a while to replenish that, but they're not going to go up another 22%. That's a transitory. Now, all of these do have a factor of transportation costs. Target yesterday came out and got severely punished. One of the things they said is this year they're going to pay $1 billion more in transportation costs. So that's going in. You're seeing in all of this. You're also seeing wages. In all of these, to produce everything that you're seeing here, you have wages, and those are probably not as transitory. I'm sure everybody is focusing over on that zero and saying, what is that? Eric, tell them what that is.
Beautiful 0% inflation was in the Costco hot dog food and drink, $1.50 since 1984. So it was interesting as we were putting this presentation together last night, finishing touches, there was a tweet that came out that said Costco finally decided to raise the price, but it ended up just being a spoof. So we were going to have to come in and change this, but still holding strong at $1.50 is nothing better than a breakfast, lunch, and dinner at Costco to get you through.
Yeah. So there are things that are transitory. There are things that are not. Let's go over to the energy side, because that's the thing you fill up each week, and you look and you say, wow, gas is 4.5, or in fact, Jake, tell me what it costs you to fill up your Suburban in California.
Yeah, I mean, we went on spring break. We took the kids down to California, and we paid $165 to fill up the entire tank. So that's
that will wake you up and remind you of what inflation looks like. But this chart, we bring it up. It's the last 20 years, and you say, so what have we seen? Well, we saw $145 a barrel for oil in 2008. And less than a year later, it was at 34. So will oil stay above $100? For the next year, it may, but over the next 2 years, it's not, because you have people, drillers in Texas and North Dakota that are frackers that are going to drill as much as they can, because at $100 a barrel, they make a ton of money. So I would suspect in 18 to 24 months, you're going to see $3 to $3.50 a gallon gas again. So that is more transitory. But if we move on to wage growth, and that's one, where you look and you say, after the 2008 Great Recession, we had limited wage growth, 2 to 3%. And that was basically what was inflation. Now it's jumped up post-pandemic, because we basically have 700,000 people less that are working than were back then. And so that's something. Gasoline prices, oil goes from 110 down to 60. Yeah, prices are going to come down. If I gave somebody an 8% raise this year, next year, I'm not going to say, I'm going to lower your salary by 8% because there's more people out working. People are going to quit. That's going to be built into higher costs for companies. I mean, it's just a fact. So that's not so much a transitory. When you look at mortgage rates, that is one where you're looking and saying, well, why are mortgage rates going up? Well, mortgage rates are going up because the Fed's been talking about raising rates. And as Eric talked about, they control the short-term rates, but they've talked about wanting longer-term rates to go up because they want to cool the mortgage market. And Jake brought up something yesterday, that some numbers that were really astounding. I mean, oh yeah, if you go from 2.5% to 5%, it changes your mortgage payment. But Jake, why don't you share what you were sharing with me yesterday?
Yeah, I mean, it's just about housing affordability, right? So in January of 2021, the median home price in the US was just about $400,000. And the mortgage you could get was about 2.65. Today, fast forward to today, the median home price is 525,000. And as you see here, roughly 3% on the 30-year mortgage. If you have 20% down on a home, that payment goes from what was in January 2021 of $1,300 goes up to about $2,300. So $1,000 more today than it was just a little over a year ago.
Yeah. So it's really showing that not only is it the interest rate on your mortgage, but a 20 or 30% increase in house prices just make it nearly unaffordable. Now, because of the low inventory of houses for sale right now, you're not seeing an immediate impact of that. But this year, the estimate is this will be the first year since 2006 that the number of new homes and single and multifamily homes that are being built will exceed the number of new households formed. And so I think it's just a matter of time. You say, well, why does the Fed want to slow that down? They want to slow it down because if real estate gets in trouble and plummets, banks get in trouble. And if the stock market drops 20%, which is just about what it's done on the S&P, and on the NASDAQ, it's been about 30%. The banks don't get in trouble because they don't lend a lot of money on stock. But if you look at the balance sheets of banks, they lend a lot of money on real estate. And if they get in trouble, the economy doesn't work very well. That was proven in spades back in 2008 and 9. So they want to slow that growth down and they want to rein it in, and they will probably do it pretty easily here. But it'll take a while. It'll next 12 to 24 months. Now, is the GDP softening here? I talked about the minus 1.4% first quarter. Still, first quarter, that was more of imports and inventory adjustments than anything else. But will it slow down a little bit? It will. But if you look at the components on the right-hand side of GDP, 68.5% is consumption. And if you look at consumers and you look at corporations and even the 17.2% in government spending, all of those are in good shape because most people have a job. Most people paid down debt during the pandemic. And there is excess savings in most people's financial balance sheet effectively. And governments, because real estate's gone up, stock prices have gone up, people have sold, they're making more money, they're paying more taxes. California is actually going to have a surplus, it looks like, which is hard to believe because they never have a surplus. But you probably will have some slowing, but we don't think it goes into a recession. And if it does, it's probably not a bad recession. So we're concerned about what the Fed's doing. We're concerned about interest rates going up and that impact. But the general GDP and the economy is still in decent shape. It's going to slow down some. It's not going to be as good as last year, but we don't see a big recession coming right now. I'll turn it over to Jake to talk more about the impact of that to the markets and our portfolios.
Yeah, thanks, David. Yeah, so I want to spend a little bit of time talking about this regime change and the current economic environment and how it impacts investments. And I think what's on top of everybody's mind is, what are we doing about it right now? So, so to kind of set that stage, let's talk about what are the main sources of volatility and uncertainty right now. And it's really a combination of multiple things, it's not just one thing. And just to give you an example, so geopolitical risks, as David talked about, it's at the highest it's been since September of 2001. So right after 9/11, really. And higher geopolitical risk, it impacts, it typically means lower investment, sometimes lower stock prices, lower employment generally, or even a higher probability of some type of economic downturn within the global economy. And so the Russia-Ukraine conflict, as well as the China lockdown that David mentioned, I mean, these are all things that are affecting supply chains, and that's putting upward pressure on inflation. And as Eric mentioned, due to inflation, the Fed is trying to combat that and rein that in. And so in the last 2 meetings this year, they have raised rates. They have 5 more meetings left in the year, and we expect them to continue to raise rates throughout the year if inflation stays high. But as rates have come up, that's now putting pressure on valuations. So we've been talking about valuations for a long time, and by nearly every metric, the stock market has been overvalued for a long time. Even with the recent decline, their valuations are more reasonable, but they're not cheap by any metric. And so this rise in rates has affected both stocks and it's affected bonds. But let's focus a little bit on stocks here. One of the biggest stories I would say this year has been leadership has changed. And we've kind of talked about this. We've been monitoring it for a while, but this is large cap equities, so large companies in the US. And over the past 10 years, the trend has been growth. Growth has done about 15.6% annualized over the last 10 years, where value has done a little over 11. So certainly this has been the place to be. That's changed this year. It changed a little bit. The last couple of years has been going up and down, but for the most part, growth has still stayed steady. Completely different this year. Growth has been getting hammered. That's down 20. And this is as the end of April. Right now, if you look at the NASDAQ, it's down nearly 30%. And value has been a place that it's been holding up okay. So that's one of the big things this year on stocks that I think is worth noting. And so let's talk about what we've done on the stock side. And as we've mentioned many times, our models don't predict. It's not going to predict what's going to happen. It's more adjusting to market conditions. And so our models have really done three things this year. The first thing it's done is it's made a dramatic shift towards value. So there are a handful of strategies that we run. This is what they look like at the very end of last year. So you could see a pretty heavy weight towards large cap growth. This is where we're at today. So we've added 3 times the amount of value, so far this year in these strategies. They've continued to adjust towards that trend. So that's probably the first thing. And it's not that we've given up on growth. It's just that the trend has been stronger. So we put more weight there. The second thing we've done is we've shifted to more of a defensive posture in some way. And what I mean by that is we've selected investments that tend to have a little bit lower volatility to them. So that's been one thing that's changed. And then I would say the third thing that we've done is through risk management. There's some stock exposure that we've had that we've moved to cash in an effort to preserve. And, when volatility comes back down or that trend tends to reverse, we'll move that back in. But that's been one of the other places that one of the other things we've done on the stock side. So we'll continue to let our models kind of adjust to the current conditions and kind of stick to our approach. But that's on the stock side. Let's talk about the bond side, because generally when stocks are declining, that usually means interest rates are falling, which typically benefit bonds. Over the last 8 years, where the stocks have declined on a calendar year basis, bonds have benefited from that. So this is going all the way back to 1977. This year has been quite a bit different. You've had both stocks going down, and because of interest rates rising, that's pushed bonds down, and it's pushed bonds down a lot. This is the aggregate bond index. And if you go back over the last 40 years, the worst calendar year decline was 1994. It lost 2.9%. So you can see this is 3 times more so far where we're at this year than in previous years. Now, again,
okay, Jake, so that shows calendar years. What kind of declines have we seen intra-year?
Yeah, so there's been several times where the aggregate bond index has lost a lot. I mean, 2008 was a good example where, it was probably down double digits sometime during the year when there were some liquidity issues. There's been other times where we've seen 5% declines, but by the end of the year, they've always kind of rebounded back. We'll see what the rest of the year has in store for us. Probably the only way that happens is if, stocks continue down and there's a big flight to quality, and, that pushes interest rates down, and then, those bonds will rally. But, that would be probably more negative for stocks probably. So.
Yeah, because when I see the basically 10% negative, return year to date, this is not liquidity issues. I mean, it's not like March of 2020 or in the fall of 2008. This is just interest rates going up.
Yeah. And I think the other interesting thing too, and you mentioned this in other conversations, Dave, is when you look back into the 70s and 80s, interest rates were much higher. So that yield on those bonds could offset some of this, and rates are just too low right now to offset it. So that may be one question you might have is, why is there a lot of cash in my portfolio when I look at it? Well, I feel like this chart kind of tells that story. And the reason is because there really hasn't been a place to hide in the bond world. This is a handful of different asset classes. The black here is the aggregate bond index that we talked about. Right here is bank loans. That's held up better than most. You got junk bonds that are down 11. You got high yield munis that are down 12. Preferred stocks down 15. Emerging market bonds down 16. I mean, long-term bonds are down probably more than 20% year to date. So there is just has not been many places to hide. And most of the decline here has probably been due to interest rates. Part of it's also been to credit spreads widening. But either way, this is just a good example of why we trade bonds the way we do. I mean, when you look at our bond portfolio, we're down right around 2% in most portfolios there. And most of that has been due to our risk management, the pieces that we've been able to get out of most of these asset classes early on as their trends started down. And just to kind of show you that in action, this chart just shows you high yield bonds and over the last several years. The red arrows are just showing you where we sold. The green are showing you where we bought. And so we've been able to avoid some of these large declines. I mean, it did really well during the pandemic. And we're seeing the same thing operate the same way right here that we've seen this year, is that we've been able to get out and there's been a big decline. So bonds are sometimes boring, I think, when people look at them, but we get pretty excited when we've been able to get out and then things continue down like they have. And that's because we see opportunity. When things turn around and that trend changes, usually that leads to some really good returns going forward. So
Jake, what are some of the yields that we're looking at today compared to 6 months ago or 5 months ago?
Yeah, even if I go back to this chart here, the yields have gone up quite a bit. I mean, you think about junk bonds and even high yield munis. High yield munis have gone from probably in the 3% range. They're in the 4 to 5. If you look at some of the junk bonds and preferred, you're looking at 5, even 6% in some cases. So that's the other opportunity. When we get back in, that will lead to some usually better dividends, as well as some potential for capital appreciation as well. So, and we've been running this strategy for 10 years now. This just goes back the last 5, and I think it's worth noting on the left-hand side, this is the return just over the last 5 years. On the bottom, this is risk, and we measure that by standard deviation. Here are those same asset classes that I just went through. So bank loans, junk bonds, emerging market bonds, high yield munis, and preferreds. All of these have a lot more risk associated with them. You expect to get paid more by being in them. Over here on the left is the aggregate bond index. Lower risk, typically lower returns. And so what you've seen is this bond strategy has been able to produce really good or superior risk-adjusted returns, right? Like, we've been able to get a better return than some of the riskier asset classes, but we've been able to do it with a whole lot less risk, similar to the ag. And that, I think, is something I cannot stress enough, is this is the reason why we trade the way we do. So even though you may see some cash within the portfolio, that usually is for a short period of time, and we'll be able to try to get back in and take advantage of these opportunities. So let me just kind of summarize it here. as we talked, we see this regime change of the Fed focusing on inflation, and we think that is going to be a headwind on the markets, given that they're trying to normalize rates and reducing their balance sheet. So at the moment, that is kind of the end of easy, cheap money in a way, right? Now the Fed may, they may pivot again and go back on what they're saying, but that currently is the trend, and we see that continuing through the year. As David mentioned, we do expect positive growth in the market. It's not going to be as strong as last year, but most of that is being supported by consumers and corporations and governments. And inflation is impacting that. We're seeing that with some of the recent announcements with Target and Walmart. I mean, it's making a big impact to everybody. The other thing with declines in markets, there tends to be opportunities that start to show themselves. I mean, valuations are much more reasonable. You're seeing some of these growth companies just get beat up really bad just because they're associated in the growth world. And so not only are valuations more reasonable on the stock side, we're seeing the same thing on the bond side. And so we'll continue to be a little bit more defensive here as the trends, have been rough, but we'll continue to adjust those as market conditions change. So, as always, if the current market volatility or what's going on in the economy is bothering you, please reach out. We'll love to talk to you individually about, what we're seeing and if we need to adjust your risk tolerance and things like that. So I think with that, I think we have some time for some questions as we've done in the past.
We've got a number of questions coming in, some similar conversations that we've had in the past. One of the ones, I guess I'll try to summarize, it's more going back to the price increase in gas, the oil. So why isn't the U.S. just doing more to just drill and pump more oil? The current administration doesn't seem to be opening up the land leases all that much. And so, David, I know we had a conversation yesterday about this a little bit more on why isn't the U.S. just stepping up and being able to tamp down the price of gas?
Well, I mean, it's a lag effect. When the prices go up, it's not like if we were Saudi Arabia, we just turn on the spigot and 1 million barrels pours out tomorrow, but we're not. And so over the last 2 years, when the pandemic started, you had a significant drop in demand. And so oil prices, actually went negative in the futures markets for a while. So everybody stopped drilling. And if you have that stopping of drilling, you end up with an air pocket later on. And that's what you're seeing now. In fact, we're already seeing increased amount of production as prices have gone up. But it's probably going to take, if I've already have an oil field out there that I've been fracking on, and I've got additional leases there, and most of them do. I mean, it's 5 to 7 years worth of leases that most oil and natural gas companies have on hand. I can get that if it's not really, it's just regular fracking. Probably in 5 to 12 months, I can get production out. And so I think a year from now, we probably see 1 million barrels. The Saudis have not been willing to open their spigot. I think they're looking and saying, hey, we like this $100 a barrel because it makes a ton of money. And the 3 largest producers are the Saudis, the US, and Russia. Well, Russia's having problems exporting because of all the sanctions and everything else. So you're restrained there. Long term, current administration, their reluctance to do more federal leasing will have impact, but it has nearly no impact in the short term. But you are going to start seeing more and more, and you're already seeing it. We're probably up 700,000 barrels from 18 months ago as far as production in the U.S. And that will probably add, because we were effectively energy independent until the pandemic, and prices go down, people stop producing, stop drilling, and so that production tapers off. But I think, like I said before, I think the next 12 to 24 months, we'll be back down into the $60 to $80 a barrel, not 110.
Jake, we got a couple people asking, maybe you can expand on the portfolio on the umbrella of inflation. So what do we have any sort of inflation hedge in the portfolio? What are we doing? You kind of touched on that a little bit. Maybe you could expand a little bit on that.
Yeah, I mean, a couple of things, going back to the discussion on value, right? As we've shifted more to value, you get some more of those names. I mean, you tend to pick up more energy names, right? That we've seen. The other thing that we've recently done is we added a managed futures position. Some of the benefit of that is, you get the ability to go both long and short the market. You also get exposure to commodities and currencies, or places that can get exposure to. So that's been one thing that we've done. It's been a way to kind of reduce some of the volatility and also be a hedge against inflation a bit.
Right.
Well, I think also, I mean, one of the things that we've done on the fixed income on the total return side is we've added some treasury bills in the last little bit, just because now the yield is not zero on them. And so as a place to park some money for the next 30 to 60 days with nearly no risk, we've added some of that to some of the portfolios too.
Yeah.
Yeah, I'll take this one. Somebody's asking, we had talked about this going into the end of the year on, hey, do we expect any changes to the tax code, right? So we're heavy into the end of the year, kind of felt like the new administration was going to push through maybe some additional spending with some tax offset. Really at this point, being that it's May, we have midterm elections coming up in November. David will always say, everybody just wants to get reelected. Nobody's going to vote for tax increases this close to an election. And so while and we we're expecting that the administration and Congress would have to get something in before year end, but once that kind of eclipsed and we're into 2022, that it's just going to sit there and wait. We'll have to get through the election and see what happens. Does the House or the Senate change? What does that really look like? Who's in power? But in the end, everybody wants to get reelected, so we don't anticipate any changes at this point. We were really prepared to pull the trigger on a number of financial planning changes towards the end of the year, and those have kind of just gone by the wayside at this point. So another question I'll summarize that I've gotten a couple of different questions is more about kind of going back to the 70s and 80s. So long-term high inflation or stagflation, right? We see a lot of those words coming across. David, I don't know if you want to touch on it, or is this the stagflation is going to happen again? Kind of where do you see this going?
Yeah, I don't see stagflation right now, simply because the consumer is in great shape. They're willing to spend money. Everybody that wants a job, has a job. We had fairly high unemployment numbers back then, and your income was not going up to meet the inflation numbers. So could we, if things slow down substantially? Yes, but right now I don't see it. I mean, I do see high inflation that will probably, some of it's transitory. It comes back down in the next 12 to 24 months. Are we going to be at 1 to 2% inflation going forward? Probably not. It's probably 2 to 3. And so therefore, we're probably not going to have as lower rates. But for most investors, higher rates, we can make more on the bond side too. So there's nearly everything that happens. Could be good, could be bad. And for us, higher rates could be good on the yield on the portfolio.
Dave, why are people worried about stagflation? And there may be some people that don't really understand what stagflation is, right? So maybe touch on that.
So stagflation is stagnant growth, stagnant economic activity. So you're not growing, and inflation is going up. So that why that's so bad for not just individuals, because your income is not going up and your costs are through inflation. Mm-hmm. But if you're a company, it usually means that my margins are getting less because my input prices are going up. And that's what we saw with Target. And they didn't say they couldn't pass on the cost. They just said they hadn't passed on cost. And so what happens is, if my inputs are higher and I don't raise my prices to meet that, my profit's less. My profit's less, my stock doesn't go up as much and it goes down. And that's why stagflation was so bad for the stock market. Margins would go down.
So the difference between the 1970s and maybe even the early 80s with stagflation versus now, I mean, they're obviously different environments, right? So
yeah, no, absolutely. And back then in the late 70s and early 80s, everybody had 8, 9, 10, 11, 12% mortgages. When you got a 2.5% mortgage and it's for 30 years, you're set as far as your cash flow. So, and when we look at debt service, so all the debt payments somebody has relative to their income, the average consumer is better than they've probably ever been in the last 50 years.
that's one of the big problems with inflation right now is just lower income earners. I mean, it's impacting them a whole lot more than, somebody in the middle class and things like that, right? Like that's really where it makes a big difference.
Yeah, and we're not saying that inflation's not a bad thing. I mean, it absolutely is. It erodes your purchasing power and typically hurts the lower economic echelons of society more than the billionaires, for sure. I mean, I doubt that Bill Gates is going to say, I just can't, fill up my car anymore because it may cost $160. But somebody that's living on $18 an hour, they may look and say, I'm not going to go to California because I can't afford the gas.
Yeah.
So another question that's come in, we try to address this in a lot of our one-on-one meetings. David, maybe you kind of take this. So how do our models predict re-entry? So we've made a lot of changes this year, risk off a number of different times, fundamental changes within the portfolio that Jake was talking about, growth to value, some of the hedge, but talk about predicting re-entry on some of our models.
Well, it depends upon the model, because on the fixed income, it's completely different than it is on the stock side. So on the bond side, basically, as Jake was talking about, we don't have a crystal ball, it's reacting. And so the trend has been down. Well, the trend has to level off and start going up a little bit to say, okay, the trend's positive, not negative. And that takes time, but it's pretty easy to see, hey, are we starting up that way? Right now, the trend's still down. I mean, you look, say, in the next week, are we going to get back in bonds? I can tell you absolutely not. Why? Because the trend is not even flattened out yet. On the stock side, there's different models that we use. One, and the one that probably drives more than anything, is the volatility. Higher volatility, and you saw it in spades yesterday. I mean, the S&P dropped more than it has since, I think it was June of 2020. As long as it's volatility like that doesn't correlate with, oh, it's a great market going up. It usually correlates with a market going down. If that levels off and the market starts to go up, then our models will probably get us back in. But a big chunk on the equity side is looking at the volatility. If it's really volatile, you want to have more on the sidelines.
And then just some of the long-term trends as well, like on the stock side, right?
Yep.
I mean, we've clearly been in kind of a not only short-term, intermediate term, and long-term downtrend. Those will have to change around as well. So,
but you will probably see, I mean, some of the biggest gains on a daily basis occur in a bear market, because you have a big drop like you had yesterday, and then all of a sudden, you have a huge bear market rally as people cover shorts and say, I got to get back in. It's gone down too much. So don't get confused of, hey, the market went up 3 or 4 or 5%. It's a great time to get in. That happens quite often in bear markets.
So we got somebody asking, kind of going back to the tax code question. I know, Jake, on the financial planning side, one of the things that was proposed at the end of last year that didn't pass was the closing of the backdoor Roth loophole, right? So there's a lot of people that feel like that's a loophole within the tax code. Again, any thoughts on that loophole being closed? That was part of the Build Back Better plan.
Yeah, it's still something we're waiting to see. There hasn't been any definitive, legislation passed or anything like that has closed that loophole. So we'll continue to monitor it, and it's been something that we've been able to take advantage of for a while now, and hopefully we can continue to do that. But we'll wait to see. So nothing at the moment.
Politics or politics, you get Kristen Sinema, Joe Manchin, that they love being in the middle and being able to really decide what goes on and pull their support or put their support behind things. And I'm not sure they're going to give that up between now and the election. And again, try to see the dynamics of the House and the Senate potentially change, and then who gets to play that key role. So again, we can wait, but at this point, it's still in play.
No.
Go through I think probably broader question is, we've discussed crypto in the past. Someone had brought up the question of, why is crypto going down? A lot of conversation early on about crypto being an inflation hedge. Doesn't seem like we're seeing that. We haven't added or touched any crypto within our portfolios, but David, thoughts on the crypto decline that we've seen?
Well, it's interesting because when crypto was going up, everybody was talking about, oh, this is the new store of value. It's going to replace gold as far as the hedge that you'll have. The reality is, when you look at the math as correlation, it's really a levered play on the NASDAQ. So if the NASDAQ's going down 1.5%, it's going down 3%. And you've seen that. You were at 67,000 and now you're below 30,000. And you've had some of the, not Bitcoin, but some of the ones that were supposedly stable value coins, where they were going to stay at $1, just like money market. One of those in the last week went from 98 cents to 1 penny in a day. So we're continuing to see a lot of volatility. It's clear that it didn't work as they thought, but neither is gold. If you would have told me, 2 years ago, look, we're going to have, 8% inflation, where do you want to be and what will do well? I'd say gold. And yet, it's done better than the market, of course, but it hasn't done what people thought it would do. Part of that may have to do with Russia. Russia had stockpiled billions of dollars, probably hundreds of billions of dollars worth of gold. They're probably liquidating some of that since, the first of the year and the invasion of Ukraine to support that. And that's probably masking some of what you would normally have seen in gold. But silver, silver's lost, probably 20% of its value. So some of the things that people thought would happen have not happened.
Yeah. Well, I'll marry these two questions since I think they're somewhat related, or at least I'm reading into it a little bit. So kind of a prediction. So how low do we think the stock market can go, right? A lot of conversation on huge percentage of the S&P and NASDAQ stocks are in a bear market. So how much lower do we think it can go? And then given that, is now a good time, therefore, to be contributing to, 529 plans, your Roth 401k? I think, is it more, maybe it's a timing question.
Jake, you want to talk to that?
As far as how low the market can go, obviously you have no idea of how far it can go down. And we've seen bear markets that, you've seen greater than 50% declines. I think the NASDAQ is a great example back in the tech bubble, where you saw it go down to 80%, right? So could it do those type of things? It could. But again, I think the thing that's been a little bit different here is going back to some of the things that David's talking about on the economy and things like that. We're still in pretty good shape in a lot of reasons, and there's some silver lining. The other thing that I would say too is that sentiment is extremely negative right now. That historically has been a contrarian indicator. Not to say that the market couldn't continue down, but that is one thing where you see, when you see a lot of fear in the market and sentiment being as negative as it is today, that oftentimes can be a positive thing. So
yeah, that's a good point you make, Jake, because it's interesting. If you look at where historically sentiment would be, or where sentiment is right now, and what like unemployment and GDP growth would be, unemployment would be sky high at these sentiment levels, and GDP would be substantially negative. So you're right. I think people, and part of that probably is going through the pandemic and people having, I mean, nobody saw that we would ever shut down schools and travel and all that stuff, but we did. And so I think that sentiment probably is a lot more negative than the real economy should indicate it should be.
And inflation probably adds to that too, right?
Yeah.
That has impacted all of us in one way or another. I mean, that probably adds to the sentiment. I think this is when you look at some of the sentiment numbers, it's associated with a recession. I think 2011 was one of the few times where sentiment was extremely negative and we weren't in a recession, right?
Yeah.
So,
Especially, it's funny to watch that because with the best job market that we probably ever had, to see sentiment that low, it's like, sort of scratching my head.
So it's not only sentiment, it's a lot of discussion. We'll kind of close on this. What's the next level? What's the next support level? We got into a lot of technical analysis. There's a guy that used to be on Fast Money. He said, you got to keep your eye on 28.48 because that's the Dow's low print from 1898. So that's your major support right there. So with that, we'll end. I want to again thank everybody for spending the time with us today. I know we covered a lot of different topics, and there's probably a lot more discussion. So as Jake said, please reach out. Now that tax time has come and gone, hopefully you've got your returns done. We'll be reaching out to get a copy of 2021 tax returns, try to see what adjustments we need to make this year going forward. So we'll be talking to you soon. When we close out of the seminar here, the survey will come up. If you could just spend a few minutes, help us improve webcasts, any feedback, we'd love it. At this time, we're planning on having our next webcast would be sometime in August. I'm sure we'll talk to you before then, but again, thank you and have a wonderful afternoon.
Thanks, guys.
Thanks, guys.